Coming up, Australia's jobless rate holds, US inflation rises, and digital competitiveness, how Australia ranks globally. That's all next. Hi everyone, it's your daily 10-minute business and finance news wrap for this Thursday, the 14th of November 2024. The Australian share market rose today by 0.4%. We'll have the details with James Whelan from BPC Wealth Management. But first, we'll start with the Australian economy, where the Bureau of Statistics says Australia's unemployment rate remained at 4.1% in October. That's for a third straight month. There was a slight fall in the participation rate from a record to 67.1%. Nearly 16,000 jobs were created in the month, but it is below the average growth of the prior 6 months of around 45,000. So what does this say about the economy and the direction for interest rates? For more, I spoke with Harry Murphy-Cruz, an economist at Moody's Analytics. Harry, first of all, how would you describe the employment market at the moment?
The labour market's incredibly sturdy. It's kind of defying all expectations, really. We saw that in the numbers today. We had unemployment stay at 4.1%. Go back before the pandemic, we had unemployment that was around 5.1, 5.2%. If you look at some of the indicators like the participation rate, that's at a record high. That's a really good indicator of how people are perceiving the labour market. If you've got a high participation rate, it says people are being drawn into the labour market because they think they'll find jobs. And even like the youth outcomes are particularly strong at the moment. Often, young people are the canary in the coal mine for labour market weakness. They're the first to feel it. Well, over the last couple of months, we've seen some pretty sturdy numbers come through. So, yeah, the labour market overall being this kind of shield for workers and families.
Why do you think it is remaining so resilient?
Yeah, it's a tricky one. I mean, we saw the RBA governor today give a speech just ahead of those numbers, and she outlined two key reasons. The first being that demand in the economy is still quite strong. So the RBA is seeing that people are still going out and spending a little bit more than what the RBA would like. The other big one is population. We're having very strong population growth at the moment. When you've got more people in a place, that simply means people are buying and spending more, and we're seeing that show up in people hiring more to meet that need.
Are you starting to see any weakness at all because the increase in jobs growth is below that of previous month, for example?
Absolutely. So while it's been really strong, we are starting to see some weakness come through, and it's going to weaken further from here. So you mentioned that jobs growth figure. We had 16,000 jobs created through October. The 3 months before that, the average was around 50,000. So pretty sharp drop off. It's 1 month. It's not a trend, but certainly suggesting that some of the labour market is starting to weaken. Look at other measures like job vacancies. That's ticking lower again. And then the wage growth figures from earlier this week clearly showing that there is some sort of slackening happening in the labour market.
Where is this demand coming from? I saw some interesting notes from AI Group, for example, saying that the economic resilience is being driven by government stimulus, which is distorting the labour market. What do you reckon?
There's a little bit of that. I think it's also partly just look at which industries are being impacted most by interest rates. The high interest sensitive industries, things like retail, finance, business services, hospitality, all of those things are really feeling the brunt because people are pulling back on their spending. The sectors that are doing well, those generally related to government supports or public expenditure, things like healthcare, they're not really impacted by interest rates. Also, defence, not really impacted. And those last two are the ones that are seeing broader structural drivers of growth. Things like an aging population means we have to spend more on health. That's coming through in the labour market figures. Similarly, defence, we're living in a more uncertain world. We're seeing that come through in defence expenditure.
So ultimately, how do you think the RBA will now view these sets of numbers? What does it say about the economy, this labour report, especially when you combine it with the other recent data? We saw the wages data yesterday and ultimately the implication for interest rates.
Yeah, so if you take a step back, what the RBA is trying to do with high interest rates, obviously trying to take some of that extra demand out of the economy. They've done that in a number of different respects. We're seeing retail sales figures continue to be weak. We're seeing it in business investment as well. Where we're not really seeing it is in the labour market. So today, there was a bit of good news, a bit of bad news if you're the RBA. The bad news being unemployment hasn't shifted. They would have loved to have seen that tick up to 4.2, for instance. But the good news is the weakening that we have seen, the weaker job growth figures that suggest that the labour market is weakening from here, and still, I think, on track for unemployment to hit the RBA's forecast of 4.3% by the end of this year, up to around 4.5% probably by the middle of next year. For interest rates, not a lot coming out of today's data. It was broadly as expected. Still very unlikely that we'll see any rate cut this side of Christmas. We still think that the first rate cut, most likely in February, we'll get that final quarter inflation print. That should be enough evidence for the RBA to cut. But that said, we've seen some pretty interesting events over the last couple of weeks that could see that push back towards the middle of the year.
That is Harry Murphy-Cruz there from Moody's Analytics. Let's move on now. And Australia has risen in a global list of 67 countries ranking digital competitiveness. It's up one place to number 15, behind Canada and China in the IMD World Report. And Australia performed well in new measures like AI research, but future readiness is still a concern. For more, I spoke with CEDA economist Melissa Wilson. Melissa, when it comes to digital competitiveness, how is Australia doing? What are we doing right? And why does it matter?
So the results today show that Australia remained pretty steady at just up one place to 15th in the digital competitiveness ranking. It's a pretty solid result amongst 67 nations. It shows that we're doing well in some pockets, but we're lacking consistency in others. So when you look at the places we're doing well, it's really good to see we've got some strengths in some new measures included in this year's survey around AI, looking at things like research into AI and governments passing law around AI. It's also really pleasing to see that we've done really well on our regulatory framework. That's up to 5th, which is really great. And also really nice to see that we've done well on technology exports, especially seeing as the government has been really focused on that area. And it's an area we know is good for jobs and good for wages as well. So there's some pleasing areas in those three pockets.
On the flip side, where can Australia improve?
Yeah, so we've been following this survey for a number of years now, and it's shown some areas of persistent weakness, and we've seen that again in today's results. So one area of weakness is around business agility and future readiness, the agility of companies, their ability to respond rapidly to opportunities and challenges that are coming at them. We're seeing that Australia has some work to do to catch up there. We're also seeing that the training and education system is letting us down in some areas. So we ranked 27th overall for training and education, but in the 40s when it came to things like producing graduates in science and also in work-related training as well. So we really need to boost education in some of these digital areas. And the other area that we performed poorly on was around some of the digital infrastructure. So critical infrastructure such as internet speed, just having reliable, fast internet, we're not doing so well compared to other countries. And cybersecurity, we're falling behind as well, particularly in government cybersecurity. So we've got some catching up to do in those areas.
So given that, what's the message to both governments and businesses?
I think the message for businesses is they need to be more dynamic. It's really pleasing to see that governments are making laws around AI and researchers are doing good research around AI, but it's really the business sector that's going to play a critical role in making us competitive and really investing in these new areas of digital opportunity. We know that we don't have a great track record in Australia when it comes to translating research into commercial opportunities, for example. CEDA had an AI leadership summit recently, and there was a lot of discussion there around some hesitancy and risk aversion in the business sector when it comes to adopting AI, and sort of contrasting that to the more embracing, we've seen, consumers embrace these AI opportunities. And so we've really got to think about what the business sector's role is to play there and how they're going to be really agile and embrace these opportunities. On the government side of things, it's really important to get the fundamentals right. So thinking about critical infrastructure, fast, reliable internet, safe and secure cyber, and also the education side of things. The survey shows we've got some catching up to do there as well.
Of those nations doing well, what are they doing right?
So the top 3 performers in today's survey are Singapore, Switzerland, and Denmark. And what the survey shows is they're ticking all the boxes. They're really getting the balance right between having governance and guardrails and safety in place, but also embracing these new technological opportunities and really running hard at them. They're getting that balance between the two, and that shows that they're really setting themselves up to be leading digital nations over the years ahead. So Australia and others can look to that example if we want to sort of get ahead.
That is Melissa Wilson there, an economist at CEDA.
Now, Market Day on the SBS On The Money podcast.
The Australian share market rose today with tech stocks and the financial sector leading the way. The S&P ASX 200 up 0.4% to 8,224. With the details, I spoke with James Whelan, Managing Director at BPC Wealth Management. James, what's driving the market today?
We are seeing a sort of a yin-yang battle between financials and resources. Financials being with more buyers and sellers and very much in the green versus the resources in the red. We've seen the commodities prices take a little bit of a hit overnight, and that's affecting the resources. And the good old financials will always get bought around in Australia.
Okay, let's talk US inflation. It rose to 2.6% in October. What's this likely to mean for US interest rates? Because it's happening just as the US Federal Reserve begins cutting rates and as Donald Trump prepares to become president. And there's this talk about potential trade tariffs reigniting inflation once again in the US.
Yeah, we are going to be seeing something that is going to be very, very difficult to reconcile. We've got a Trump presidency, which is always going to be seen as being inflationary. Tariffs, deficit, tax cuts, everything that's going to go in towards. We've already seen real rates see an increase. On the converse side, we're going to see that the core inflation, which is the main thing that the Fed looks at, has been easing and is as predicted, and has been moderating just as expected. Powell's plan has worked, and we are seeing that rates will almost certainly be cut again in December. The reconciliation that has to be made is that we're seeing real rates go up, and we're seeing that Powell's plan of cutting rates is also being put into plan. Those two things probably won't make much sense next year, but for the month ahead, it's definitely factored in that it's another 25-point cut by the Fed.
Okay, the currency, though, is continuing to slide. The Australian dollar is continuing to slide closer to 65 US. It's more of a story, I guess, of a stronger US dollar. What's behind that?
Well, it's always a tale of two stories when you're talking about FX rates. So in the US, keep it simple as you like. Trump, inflationary, tax cuts, deficit increase, tariffs, inflationary, rates up. That's the way that's going to be driving the US dollar higher, and it has been doing so. Over here, we've also got the fact that our biggest trading partner, China, is going to be seen as has already been seen as being a little bit weak anyway. Sorry, when I say a little bit weak, that is an understatement, as being seen as being massively on the back foot, and then being hit even more by potential tariffs to come in, or a potential increase in tariffs to come in more accurately. We're seeing that the Aussie dollar is also going to be taking a bit of a hit. Those two things working against each other, seeing further decreases in the Aussie dollar versus further increases in the US dollar.
Finally, where do you see the opportunities for investors at the moment?
I actually believe that the Chinese theories are being overblown somewhat, that we'll see a recovery in the Middle Kingdom in 2025. We're going to see an overcompensation in stimulus in China. If you want to take a punt, or if you want to have a really good investment, buy something on the back foot that is going to be leveraged to that Chinese resurgence as they overcompensate for the tariffs and make more hay than I think that they need to make. Well, the sun is definitely not shining at the moment.
That's James Whelan there from BPC Wealth Management. This SBS On The Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.